In this week's episode, I'm going to tell you the 3 things you need to know about taxes on your Social Security benefits. Let's get started. Hey there, this is Patrick King with Prana Wealth. On this channel, we help you build your wealth faster so that you can make work optional sooner. So if you're new here, please consider subscribing. And don't forget to sign up for our email newsletter at pranawealth.com/newsletter. It may be frustrating to learn that after decades of seeing FICA taxes deducted from your paycheck, your Social Security retirement benefits are still subject to income taxes. Sure seems like double taxation, doesn't it? In today's episode, we talk about 3 things to know about taxes on Social Security income. Is this something to be stressed over? Be sure to stay to the very end to find out. Please note that this week's episode only covers the taxation of retirement benefits. Next week, I'll cover the reduction in Social Security benefits for those who are still working before their full retirement age. Okay, the first thing to know is that taxes on Social Security income are progressive. Much like income taxes, the tax on Social Security income is also a progressive one. The higher your income, the more you pay. The taxation of Social Security benefits is based upon something the IRS calls combined income. We'll touch on that momentarily. Only a portion of your Social Security benefits is taxed. For married couples with combined income of less than $32,000, none of their Social Security benefits are included in their taxable income. If a couple's combined income is between $32,000 and $44,000, half of their Social Security benefits are taxed. Finally, once a couple's combined income exceeds $44,000, 85% of their Social Security retirement benefits are included in their taxable income. For single filers, the income limits are different. Social Security benefits aren't taxed at all for combined income under $25,000. Half of the benefits are taxed if combined income is between $25,000 and $34,000. And finally, 85% of benefits are subject to tax if a single filer's combined income is over $34,000. It's important to point out here that these percentages, 0%, 50%, and 85%, apply to how much of the Social Security benefits are included in taxable income, not the tax rates themselves. It doesn't take long to realize that avoiding taxes on Social Security is difficult unless you don't have any income. These combined income limits were last updated in 1993 and have not been adjusted for inflation over the years. Because of this, the overwhelming majority of Social Security benefit recipients end up paying taxes on their benefits. Depending on how you feel about the government's stewardship of our tax dollars, it may or may not be of some comfort to know that taxes on Social Security benefits go back into the Social Security trust rather than be included in general spending. The second thing to know would be how combined income is calculated. Even though the limits are relatively low, it's still worth understanding how combined income is calculated. According to the IRS, combined income is calculated as follows. Start with your adjusted gross income, your AGI, add any non-taxable income, and then finally add 1/2 of your Social Security income. Even if you have minimal taxable income in retirement, such as a pension or distribution from a tax-deferred retirement account, you can find yourself being taxed on 85% of your Social Security income awfully fast. It's also interesting to note that non-taxable income, such as interest from municipal bonds, is added back into this calculation. Seems that Uncle Sam doesn't want to give you a double benefit in this case. Third and finally, minimizing taxes on Social Security should be a low priority item. If you're trying to create a retirement income strategy, minimizing taxes on your Social Security income should be low on your list of priorities. Because the combined income limits are so low in relation to most people's retirement income needs, it's difficult to minimize these taxes outside of having a 0 income year. Remember, at most, only 85% of your Social Security income is taxable. Compared to income from an IRA distribution, which is 100% taxable, it's clear that other efforts can go further in reducing your overall tax bill. Rather than focusing on minimizing taxes on Social Security benefits, Other tactics, such as making strategic Roth IRA conversions before age 72, could potentially reduce your overall lifetime tax payments. While it's important to understand how Social Security income is taxed, there are other considerations that should take priority when planning your retirement income strategy. If you need help designing a plan to minimize taxes and maximize income in retirement, then visit us at pranawealth.com to see if we are a good fit. We do still have the capacity to take on new clients. As a fee-only financial advisor in Atlanta, we can and do work virtually with clients all across the U.S., and we're ready to help you whenever you're ready. Hey, if you found this video helpful, please help me grow my channel by liking this video and subscribing to my channel. And don't forget to sign up for our email newsletter at pranawealth.com/newsletter. Thank you so much for watching, and I'll see you soon.